Stocks rose today on ceasefire hopes, but the same morning, the price paid component of the ISM Services Survey hit a 3.5-year high, and those two facts cannot both be right. Jamie Dimon released his annual shareholder letter Monday, and it reads differently from every prior edition. In past years, he forecast what might go wrong. This year, he is accounting for what already has. The U.S. is an active combatant in an ongoing war, and Dimon's conclusion is unambiguous. The Iran conflict is pushing the global economy into genuinely uncharted territory. The mechanism runs through Hormuz. The strait channels roughly 20% of global oil supply. Iranian attacks on UAE petrochemical facilities and Kuwait refineries have already disrupted output. The IEA warned that even a ceasefire would require months for infrastructure repairs before normal flows resume. Goldman Sachs revised Brent crude forecast to $98, up roughly 40% from last year's average, and raised U.S. recession risk to 30% under a prolonged conflict scenario. BlackRock's Larry Fink put a harder number on it. Oil at 150 triggers a stark and steep recession. The inflation channel amplifies the damage beyond energy. Dimon flagged fertilizer, helium, and global shipping as downstream casualties of the oil shock, supply chain disruptions that would compound into food and farming costs. Goldman revised December 2026 PCE inflation up to 3.1%. That matters because the Fed's target is 2%. The market is pricing only a 1% chance of a rate hike at the April 28-29 FOMC meeting, but that pricing was set before the ISM Services Prices Index surged. Morgan Stanley added one more compounding risk: wartime defense spending piling onto already elevated U.S. debt, pushing long-term Treasury yields higher. The 10-year break-even inflation rate rose to a 2-week high of 2.38% on Monday, even as 10-year yields dipped slightly on safe haven demand. The contradiction, yields down, inflation expectations up, reflects a market that hasn't yet decided whether this is a geopolitical shock or a stagflation setup. Marko Kolanovic, JPMorgan's former quant chief, offered a dissenting read: let the market fall. His argument is that Trump's repeated pivots away from market pain, the TACO trade, are actually prolonging the conflict by signaling to Iran that the U.S. has a tolerance limit. The war, in this view, ends faster if the president stops treating the S&P 500 as a constraint. While the Iran trade dominated macro conversation, one stock was delivering a more specific verdict on corporate execution. Tesla reported first-quarter deliveries of 358,000 units. The analyst consensus was 372,000. JPMorgan's own forecast was 385,000. That is a 7% miss against the bank that covers the company most bearishly, and the bears reinforced their call immediately. Analyst Ryan Brinkman reiterated his underweight rating and $145 price target, implying a 60% decline from Monday's levels. The deeper issue is not the miss itself, it is the inventory. Tesla produced 50,363 more vehicles than it delivered in the first quarter, the largest inventory bill in any single quarter in the company's history. Production is up 80% since the first quarter of 2023. Deliveries are 15% lower over the same period. The gap between those two numbers is the structural argument against the stock. Tesla's trailing price-to-earnings ratio sits at 334 times. The bull case requires robotaxis, humanoid robotics, and autonomous driving to scale fast enough to justify a valuation that car sales are actively undermining. Wedbush's Dan Ives maintained his $600 price target, pointing to AI and the Cybercab launch timeline. But with operating expenses up 39% year-over-year in Q4 2025 and net income down 47% for the full year, the financial bridge between today and that future is getting harder to cross. There is one genuine bright spot: the energy storage business. Energy revenue rose 25% year-over-year to $3.84 billion in Q4 2025 on record deployments. That segment is growing, and it is not the segment the market is punishing today. The market is punishing cars, because cars still pay the bills. The stock slid 3% on Monday, extending a 20% year-to-date decline. The next hard test is the Q1 earnings call, where Tesla will need to either reset expectations or offer credible evidence that the inventory bill is a timing artifact rather than a demand signal. The two stories above, Iran-driven inflation risk and Tesla's delivery miss, share a structural feature that makes the forward picture more complicated than either story alone suggests. Goldman Sachs published a separate finding Monday. AI is eliminating roughly 16,000 net U.S. jobs per month. The substitution effect is running at 25,000 per month. AI-augmented job creation is adding back 9,000. the net loss is falling disproportionately on workers under 30, concentrated in exactly the routine white-collar roles, data entry, billing, legal support, that AI handles most efficiently. The entry-level unemployment gap versus experienced workers has widened sharply. This intersects with the Iran trade through the labor market. March non-farm payrolls came in at 178,000, more than double expectations of 65,000, and the largest gain in 15 months. Unemployment fell to 4.3%. On the surface, that is a resilient labor market, but Dallas Fed economists calculated the monthly break-even for stable unemployment has dropped to near zero because immigration-driven labor force growth has reversed. The economy can now lose jobs without pushing unemployment higher. That changes what strong payroll signals about the Fed's path. Put together, if the Iran war persists and oil holds near $98, the inflation path runs higher while the labor market data continues to look stable. The Fed finds itself looking at rising prices, strong employment numbers, and a structural economy that is not as robust as the headline numbers suggest. That is the scenario that produces rate hikes, not cuts, and it is the scenario that makes the ISM Services price spike on Monday the most important number of the week. The weight of evidence points toward prolonged market uncertainty driven by the Iran trade, but this only holds if ceasefire negotiations fail before Trump's Tuesday deadline. If a 45-day ceasefire is confirmed, Axios reported that terms are being actively discussed with regional mediators, oil retreats, inflation expectations compress, and the rate hike narrative dissolves quickly. Bitcoin surged 4% Monday on that possibility alone. The recovery case is real and fast-moving. The benchmark to watch is Trump's Tuesday evening deadline for Iran to reopen the Strait of Hormuz. If that deadline passes without a deal, the next resistance is oil at $110, the level at which BlackRock's recession model begins to activate. If a deal is announced before Tuesday night, Wednesday's open will look very different from Monday's close. One deadline, two opposite outcomes, and the spread between them is currently pricing in neither.